So one of my friends just sold his company for a healthy 8-figure payout. Now he's ultra high net worth. But he's sitting on cash, lots of it, parked at legacy banks in a single country. So yesterday he sent me this message. Hey Chris, I'm worried about having all my money tied up in one country with a couple of banks. I want to spread my risk around. Where do you think I should open accounts? Now, being the nice friend that I am, I decided to help him figure out his options the same way we help our private clients. And in this video, I'm going to tell you exactly what I told him, so you can get the same results if you're looking to diversify. And I know this approach works because it's how we've helped other people navigate diversification, including Kate, who had accounts with a major private bank in Switzerland, being overcharged and underserved. We helped her diversify into 3 different countries with solid banks that met her needs and actually valued her as a client. Then there was JD, an investor with a very challenging profile who made all their money in crypto and needed a simple path to diversification across jurisdictions and banks. And Cece, who already mapped out his entire diversification plan, which included both Singapore and the UAE. But he was sitting in the United States and needed local accounts in both of those countries, which we helped him open without getting on a plane. And these are just a few examples of people that we've helped at different stages of diversification with different goals, helping them figure out the best countries, the best banks, even the best bankers for their specific situation. And if you're looking to solve for diversification, you need to be thoughtful about how you approach it. And that means answering 4 specific questions that we've refined down after helping thousands of people navigate their cross-border banking. And that's what we're going to be covering today, along with the 4 countries that I told my friend to consider for his diversification plan. Because if you're like him and you're sitting on at least 10 million in fresh capital that you want to diversify, these countries might be good options for you to consider too. This video is going to be super tactical, so feel free to pause, rewind, leave a comment, and of course, hit the like button when you hear something of value. Now, let's dive right in. The first question that we're going to cover is what's keeping you up at night? The risks, the worries, your fears. Basically, what are you trying to protect your money from? And starting here is super important because it informs your answers to every other question, and it also shapes the countries where you should be considering for your diversification. And while there are lots of different rabbit holes that we can go down here, there are 4 categories of risk that keep coming up as we've supported people over the years. And the first category of risk is litigation risk, the fear of being sued. If you've got money, you know that lawsuits are part of the game, unfortunately, and they can result in being cut off from some or all of your finances. And if this happens, it can be very difficult to continue to meet your financial obligations or even pay for legal support. This is real. I've seen it happen to people, and it's one of those things you can't reverse. After your accounts are frozen, it's basically game over, because how can you fund a new account if you've already been cut off from your money in your old accounts? And remember, litigation can happen for lots of reasons. Someone can slip and fall on your driveway, your ex-wife can get malicious, or maybe a disgruntled employee can come back for revenge. I'm going to tell you how to diversify away from this risk in the next section of the video. But first, we need to talk about risk number 2, regulatory risk. More specifically, changes to regulations, changes to policy, and how these changes can negatively impact your bank account. This can include orders being passed down from the central bank in a specific country, limiting non-resident account activity, or regulators taking a strong stance against entire industries, forcing account closures or even investigations, and capital controls or foreign exchange restrictions, limiting how much money you can withdraw and the exchange rate that you'll receive. Now, a lot of these considerations, they do depend on where you're from, how much money you have, and where you decide to bank. And speaking of where you bank, the third risk that we're going to cover is something that everyone worries about. Economic risk. And this is a big one, especially for people coming from countries with a lot of volatility. And it's usually guys like my friend who've built big businesses, successfully exited, and now they're sitting on a ton of cash or stocks. They're basically exposed to one country. And these guys have worked too hard to see their money stolen by inflation, currency depreciation, or failed economic policy. So it's a fear worth having. And on top of that, if there is a massive economic shock, there's another major risk that you need to worry about, which is the final one that we're going to cover, institution risk or bank risk. Now, in the most basic sense, we're talking about the collapse of a bank. We saw it in March 2023 with Signature Bank, Silvergate Bank, and Silicon Valley Bank, and again in May of that year with First Republic, followed by 2 more US bank failures in 2024, and a bank has already failed in 2025, a savings bank in Chicago. But bank failures are not just a US phenomenon. And institution risk goes beyond avoiding banks that are going to collapse. It also means looking at operational risk, governance risk, and opening accounts with banks that have competent compliance and onboarding teams. That way, you avoid banks that get caught up in investigations, like what happened to BPA, a private bank in Andorra in 2015. And it's also about avoiding banks that lose their correspondent accounts, like what we've seen over the years in the Cook Islands, Belize, and other small countries. The point is, you need to be aware of these risks and diversify away from them. And that brings us to the second big question that you need to answer when diversifying, which is what kind of diversification do you need? More specifically, we're talking about the 3 types of diversification that we encourage our clients to think through, because they will ultimately help you manage the 4 risks that we just discussed. And first up is regulatory diversification. This is a no-brainer. We need to reduce your exposure to any single country, any single regulatory regime, any single legal system. And we do this by helping you establish relationships in international banking centers known for stability, security, and protecting the rights of account holders. Basically, stable countries with fiscally responsible banks. Now, there's more that goes into it than that, but in a nutshell, that's what we're looking for. Which brings us to the second type of diversification, economic diversification. This one is a bit easier to crack because you can diversify across economies by just getting exposure to foreign securities, currencies, and yes, even banks. But something people often forget is to think through the interconnectedness of jurisdictions. For example, if you open an account in Germany and then you open an account in Portugal, are you really diversified? They're both in the EU, they're pretty aligned economically, and they both use the euro. Now, compare that to banking in Germany and Liechtenstein. Liechtenstein uses the Swiss franc, not the euro. It has a relatively insulated economy, and it's not part of the European Union. It's a simple example, but you get the point. Diversifying your finances takes more than just banking in a foreign country. You need to bank in the right foreign country. And finally, the last form of diversification that we're going to discuss is counterparty diversification. Here, we're talking about partnering with a wider range of top-tier, creditworthy banks to minimize bank-specific risks, maximize your options, increase your flexibility, and reduce the control that any one bank can have over you and your money. If you remember Kate, the example I gave at the beginning of the video, she was banking with a major Swiss private bank. Well, that bank felt that they could charge whatever they wanted for fees because she had all of her money tied up with them. She didn't have any options, at least not any immediate options. Now, that changed after we helped her open 3 new bank accounts with banks in Singapore, Switzerland, and the United States. But why was she banking with a single bank in the first place, let alone a massive private bank that was going to charge her insane fees well above market? Well, the reason is pretty simple. And it's a recurring problem that we see when wealthy people come to us for help. They open at a single bank, often the wrong bank in the wrong country, because their advisors, lawyers, accountants, consultants, they all told them to. And that's why the third question out of the 4 that we need to cover for your diversification plan is, what did your lawyer miss? And I'm framing it this way intentionally. High-priced lawyers from all over the world, they keep forgetting 3 really important considerations when helping their clients diversify. And I can only imagine they're doing this for one of 2 reasons. First, maybe they literally don't know that they should be helping their clients with these 3 considerations. Or second, maybe dealing with these considerations adds an extra layer of complexity that they just don't want to help with. But that's okay, because we're going to cover them right now so you don't have to rely on your lawyer to do it for you. And the first consideration that we're going to cover is functionality. I'm sure there's a better name for this, but here we're talking about banking. And that means after all the planning, tax optimization, diversification, asset protection, and whatever structure your lawyer or CPA wants to sell you, it needs to work. It needs to be able to send and receive money. And if you get the best, most tax-efficient structure in the world, the most rock-solid asset protection laws available anywhere, if you can't bank it, it's useless. You just end up with an overpriced binder with a bunch of boilerplate documents that won't help you do anything. Now, I'm not saying offshore structuring is useless, far from it. But the right structure, the best structure for your situation, needs to also be functional. And in the world of money, that means it needs to bank. Now, the second thing that lawyers keep ignoring is security. And let's just be real. The tiny offshore bank that your lawyer suggests opening with is not the most technologically sound bank in the world. These kinds of banks are prone to cyber attacks, phishing scams, and they often have outdated security systems. And don't even get me started about their online banking platforms that look like they're from the 90s. The point is, these tiny banks in far-flung islands don't have the technology infrastructure to protect your personal wealth. And frankly, the only time that we see people opening with these banks is when they have super exotic structures that can't open accounts anywhere else. Now, the third and final consideration that lawyers keep missing are the costs. And I'm not talking about the cost of setup or structuring or even maintaining your structures. I'm talking about the cost of banking. And here's a secret. If you have a high-flying offshore asset protection trust with high-risk assets, that's cool. There's a bank for that. But 9 times out of 10, you're going to be paying crazy high fees just to open the account. And forget the structure. Even if your lawyer introduces you to a bank that isn't accustomed to your personal profile or your source of wealth, they could end up charging you over-the-top fees just to review your application. In extreme cases, I've seen fees as high as $10,000, even $25,000 just to apply for an account. Not to mention the months it can take to go through onboarding just to be denied by the bank, which is what we've seen happen to clients repeatedly, including my friend who inspired me to do this video in the first place. So what should you do instead? Well, that brings us to question number 4, which is what's the fastest way to diversify? It's diversifying your banking. Where you custody cash, securities, hold fixed deposits, even manage your transactions. And to do that right, you need to open the right accounts with the right institutions in the right countries. Accounts that relieve the 4 fears that we just talked about at the start of the video, deliver the 3 types of diversification you should be looking for, and solve for the 3 major considerations that all the high-priced lawyers keep ignoring. And in our experience, you can find these types of bank accounts with safe and well-managed banks in top jurisdictions, regardless of your country of citizenship, your country of residence, or your source of wealth. But you do need money. How much money depends on the bank and your specific goals. But if you're looking to diversify, you should be looking to deposit between $250,000 to $500,000 US per account. You can get away with less, say $100,000, but in our experience, $250,000 to $500,000 is the sweet spot. Because at this level, you'll be able to access banks in a wider range of countries. Banks that offer better service, higher quality products, more personalized attention, and lower costs. So let's talk about where you can find these banks. And the first of the 4 countries that we're going to cover is Switzerland. No surprise here, Switzerland is the capital of international private banking. They invented banking secrecy, and it's one of the most stable and reputable banking hubs on the planet. If you're looking to open here, you should be expecting to deposit at least $1 million. Though $2 million will open more doors. And if you have higher risk sources of wealth, you might want to consider coming in at $5 million instead. That said, you can open with a minimum of $500,000 at certain banks, but just know that your options will be more limited compared to coming in at these higher levels. Now, I recently did a video on Switzerland where I broke down the 3 major cities for private banking, Zurich, Lugano, and Geneva. I explained the different profiles that can benefit from each of these cities and how to start the account opening process. So if that's something you want to explore, I'll share that video with you in a minute. Now, the next country to consider for diversification is Singapore. Now, don't get me wrong, it has become harder to open in Singapore over the last few years. And like I shared in my recent Singapore update, the opening policies are continuing to change. The latest changes that came into effect last year increased deposit requirements and reduced the list of clients who can open here. But most clients can still access Sing banks if they have enough to deposit and can overcome the opening hurdles. If you can't open in Singapore and you're still looking for another jurisdiction that offers similar diversification, you might want to consider Hong Kong. But frankly, we've been cautioning against Hong Kong since the introduction of the new securities law back in 2020. So if that's a concern and you still want a bolt hole in Asia, you might want to consider Malaysia as an alternative instead. Now, I want to jump back to Europe. This is a country I just covered in a video, Jersey. But frankly, if you're aiming for diversification, Jersey's just one of a group of similar countries that you could consider. And the group that I'm talking about is what we call AOFCs, Accessible Offshore Financial Centers. These are places like Jersey where you can open with very reputable international banks with reasonable deposits, usually between $100,000 and $250,000. There are a few of these places in Europe, as well as the Caribbean and Central America. And depending on your residency, citizenship, business size, and existing bank relationships, there are a number of countries in this category that could work towards achieving a more diversified portfolio of banking relationships. Okay, now the final country that we're going to cover, it might surprise you, so just hold on for my reasoning. It's the United States. You see, the US isn't the big bad wolf that everyone makes it out to be. It's actually one of the most sophisticated banking hubs in the world. And contrary to what everyone else tells you, there are a lot of reasons to bank here. Not to mention, a lot of people can bank here. Which is why, if you're not already exposed to the United States and you're looking for diversification, like my friend, the US can be a great addition to your banking portfolio, providing access to a wider range of products, services, credit cards, mortgages, and other investment offers that you're going to struggle to find anywhere else, especially as a foreign non-resident. And that's really what you should be focused on when diversifying your finances into any new country. Accessing banks that not only protect your money and keep it safe for a rainy day, but that also improve the way that your money can work for you through products, services, and even offers that align with your goals. So now what? How can you start diversifying if that's something you want to do? Well, I already have a bunch of videos on the channel where I talk about these countries, places like Switzerland, Singapore, Jersey, the US, and many other jurisdictions, including how to go about opening accounts, navigating the challenges, and the main hurdles you'll need to overcome. All of those details. And you can watch those videos and figure out the process 100% for free on your own. But if you're the kind of person who prefers to pay for results, the kind of person that understands the value of having a team of experts walk you through the entire process, start to finish, and make direct introductions to the best banks, even bankers that match your profile and needs, then there is a faster and better way to diversify. It's with the help of our team. And if that's something you'd like to consider, we'd be more than happy to take a free look at your situation and determine if we can help. But I do want to point out, We don't work with everyone, because for a lot of people, our services are not going to be a great fit. We take banking very seriously, and we're expensive, more expensive than your lawyers, accountants, and other consultants. Because when it comes to banking, we're better than them. And I know that because they all come to us to solve banking problems for their clients. Now, if you want to see if you qualify for our help, it's pretty simple. You just need to fill out a short application. It isn't long, it only takes about 2.5 minutes, and you can access it right now by clicking the link at the top of the description or in the pinned comment below. In return, we'll let you know if you qualify for our help and if you can open accounts in your preferred countries. If you can't, we'll even tell you which countries you might want to consider banking in instead. So fill out your application right now by clicking that link at the top of the description, or go to globalbanks.com/apply. And if you're not ready to apply for our help, no problem at all. Here are 2 of the countries that I just mentioned in this video: Switzerland and Singapore. Take your pick, and I'll see you over there to tell you all about them right now.